Hi everyone, welcome to my channel. In today's video, we'll be discussing about what do technical indicators measure. Now, there are a lot of technical analysis indicators, and one of the challenges that beginners face when they start learning technical analysis is they try to learn a lot of indicators without understanding what these indicators are actually measuring. What is the underlying quantity or underlying thing that we are trying to measure or that we are trying to find out by using technical analysis indicators. So now let's look at so it is important to understand what are these technical analysis indicators measuring so that we can avoid some of the mistakes that usually beginners make. So I have made these mistakes where I have learned a lot of technical analysis indicators without truly understanding what they are measuring, or I have switched from one indicator to another without understanding or without in search of like a holy grail. Let's look at some of the mistakes that beginners in technical analysis make. So these are some of the mistakes that even I have made. So if you are making these mistakes, there is nothing wrong. Just know that these are like some of the mistakes. Like one of the first mistakes is that having too many indicators on the charts. So how beginners think is that, or when I was a beginner, I used to think that if I had too many indicators, I would have a much better accuracy of predicting the stock price move, or I would think that I would not lose my money. I would get a more perfect or a more accurate signal if I just keep adding more and more technical analysis indicators. So this is one of the biggest mistakes. In technical analysis, there is what we are trying to do is we are trying to predict an event in future, and there is always a probability of an error. That there are the nature of a prediction system is that it is never 100% accurate. So no matter how many indicators we add, we are always going to have a prediction that will in most cases it will not be accurate. It will never be 100% accurate. So beginners usually try to think that if I keep just adding too many indicators, I'll get a more accurate signal, which is not correct, which is not right. So this is one of the mistakes. So I'll also talk about why chasing accuracy is a mistake. There is what truly matters in trading or investing is positive expectancy, that is having big winners and small losers. So trying to get every trade right or every investment right is a foolish thing, because even some of the professional traders and professional investors have an accuracy of only 30% or 50%. So even with 30% accuracy or 50% accuracy, they can be profitable because they make more when they are right and they lose less when they are wrong. So accuracy is a very wrong metric to chase or optimize your behavior towards. So as beginners, we always chase accuracy because that is what we have been conditioned to do in our schooling system as well as in the society. We are always conditioned to not make any mistakes, but in trading it's okay to make mistakes. When we make mistakes, we have to limit our losses, and when we are right, we have to ride our winners and maximize our profits. So sorry for slightly digressing. So the next mistake is that they always think that there is a constant changing. The beginners usually constantly keep changing the technical analysis indicators. They'll move from trend indicators to wave theories to momentum indicators to a lot of other things. Like they constantly keep changing the indicators or keep learning new indicators, which gives them a false sense of security, thinking that okay, I'm making some progress in my trading, which is that they are trying to fool themselves. Like I have done this as well. When I was a beginner, I used to like learning new things, so I constantly used to learn new indicators, all the new indicators, almost like there are new indicators that are being published from academic papers as well as from market technicians, people who are mastering technical analysis. They come up with new variants of technical analysis indicators. So the beginners think that if they constantly keep changing, or if they'll keep learning, they will finally end up with a holy grail of technical analysis. But just know that there is no holy grail in technical analysis or even fundamental analysis. Everything has a element of error in the prediction. So there is no holy grail in trading. The only thing that matters is losing small when we are wrong and making it big when we are right. So the next mistake is that, so when we do all this like constantly changing indicators or keep adding more and more indicators, what we finally result is that results in analysis paralysis, and which makes our decision making very hard. So when we add too many indicators, you will get a buy signal from some indicator, and you will get a like a sell signal from another indicator, or you would have it will usually result in an analysis paralysis. Each and every time you add a factor, like add a new technical analysis indicator or a new element, what some other analyst says or what the news channels says, all these are factors in which your brain is trying to make a decision whether to buy or sell based on all these factors. Like technical analysis is one factor, fundamental analysis is one factor, what the influencer says is one factor, all these kind of influence. But when you add too many factors, it will result in analysis paralysis, and that's the reason why we have to keep our decision making system very, very simple. We shouldn't let outside opinions or we shouldn't let so many factors influence our decision around buying or selling. In fact, our buying or selling is kind of important, but what truly matters is how we behave after or sell. That is, trade management is even more important to be a profitable investor or trader. So just take this thing away. Like when you're a beginner, we always try to keep adding new and new factors into our decision making. But when you get better, when you become more and more experienced, you will slowly understand that the simpler your decision making system is, it's much more easier for you to follow that system as well as implement that system, and you can follow that system for a long period of time. So always make sure that your system is simple and easy to follow. So now coming back to the 4 attributes or the things that technical analysis indicators measure. So when we take the stock price, there are only 4 things that almost all the technical analysis indicator, take any indicator, we can it will be measuring 1 or 2 of these. So we can either be measuring the direction of the stock price move, or we can be measuring the velocity or the speed of the price change, or we can measure the volatility. Volatility means the how big is the magnitude of the stock price move, whether how jumpy it is and how sensitive it is, how sensitive is the price, when the price is moving. And the fourth fourth attribute that technical analysis indicator measures is the volume, like what magnitude of the buy and sell transactions that happen between the buyers and sellers. So let's now get into a little bit much more detail, and classify the indicators. So when we are measuring the direction of the trend, what we are doing actually is we are using the trend indicators, and the direction could be either uptrend, downtrend, or sideways trend. So direction is usually measured by trend indicators. I'll make a separate video in which I'll cover some of the examples of trend indicators. That is for the next video. But in this video, we are only talking about the attributes that technical analysis indicators measures. So the second attribute that we can measure is the velocity or speed. Well, now what is the difference between velocity and speed? Is that speed is just the speed which is moving. It does not have any direction, but velocity has the direction as well. So when we were talking about the speed or velocity, what we are measuring is called as the momentum. It is the rate at which the price is changing. So the momentum indicators measures the speed at which it is changing as well as the strength, the magnitude as well. Strength is nothing but the magnitude at which it is moving. Now volatility is nothing but the magnitude of the price fluctuations, how jumpy is the stock or how sensitive is the price movement of the stock price. That is measured by the volatility indicators. Now the fourth attribute is called as volume. It measures the market activity, like when there are market participants, the volume indicates the kind of volume or the magnitude of the transactions that happen between the buyers and sellers. Like when we know that the volume is very high, we know that it's not only the retail investors, it's also like some big institutional players or the insiders who have been trading in the stock. So whenever there is a big volume, you always know that there are a lot of market participants participants, and it is probably one of the institutional investors like retirement funds or big investors or insiders who are transacting or buying or selling these stocks. So in this video, we looked at the 4 attributes that almost all the technical analysis indicators will fall into one or two of these categories, which are direction, velocity, volatility, and volume. So the things that measure the direction are called as trend indicators. The indicators that measure the speed or velocity are called as momentum indicators, and the indicators that measure how jumpy or how price sensitive the stock is called as volatility indicators, and the magnitude of market activity is measured by the volume indicators. So if you learned something new, please do consider subscribing to my channel and also share it with a friend of yours if you like this video. Thank you.